Happy FOMC Day. Today we're waiting for a decision from the Board of Governors, led by Chairman Powell, as to what he's going to do for interest rates and the speed of tapering for 2022. So everybody's sitting on their hands right now because the market's just a tad too volatile to trade until such time as we've got an idea of what his decision is going to be. So I thought in the meantime what I would do is do a quick introduction. We're starting this for 2022. This is a really key strategy I want to deploy here during the course of 2022. This is one of the key strategies I want to deploy. It's part of a series of strategies that we call the Undefined Risk Option Strategy Series. And this is the first one that we're going to be going through, which is selling put options for income. It is a bullish strategy, as you can see by this first slide we have up here, meaning we are expecting the ticker to move up. That said, you can make money on this trade if it goes sideways. You can make money on this trade if it goes down as well. So you have a variety of ways to beat the market. In other words, the market's going to go wherever it's going to go, and you can make money on it no matter which direction it decides to move. This is basically a strategy that tells you how to take on risk and get paid for it with minimal consequences. Okay, and this is, like I said, the first strategy in a series that we've put together to take advantage of deteriorating premium and options contracts by taking a short position on one or both sides of the chain, making us a full seller of options premium, and doing it with minimal consequences. In other words, with a very, very high probability of success and a very, very, very low risk profile. So in this series, we're going to cover, for each trade strategy, we're going to cover all the essentials, which is understanding the strategy from the very beginning, how to pick the underlying stock that you're going to employ the strategy against, which contract you're going to pick, what is the entry and the exit strategy that you want to have going into the trade, and you want to make sure that those are defined prior to hitting that fill button. The mechanics of the trade, the probabilities of the trade, and really important is the return on capital, because over the course of 2022 you're going to see your return on capital from this particular series of trade strategies is going to be extraordinary as compared to the risk that you're taking. If you want a better understanding of that, read about the Sharpe ratio. Okay? So our first strategy that we're going to be talking about today, which we'll go through right now, is one of the most commonly used strategies by fund managers throughout the world because of the high probability of success, the enormous profitability that the trade can give you, and most importantly, the ability to fix the trade if the stock moves against your position, right? So let's get into it. What does selling a put entail? Well, first of all, everybody I'm sure that's watching this is going to understand and know what a put contract is. Put contract basically is an options contract you take to bet that the stock is going down. When the stock goes up, a put, it's an options contract that you enter into, you buy thinking the stock is going to go down, right? So by opening that put, it gives you the right to sell the underlying at a specific price on a specific date. You're not required or obligated to do so. Most people just trade out of it. You buy a put with a stock trading at 100, it goes to 80. You sell the put for a profit and move on. But if you want, you can sell the shares at $100 each when it's trading at 80 and pockets a $20 difference minus the premium. Okay. So that's what a put is. I'm sure everybody knows what it's like, what that is, what the Greeks are, the underlying, the open interest, the volume, all the things that you do. The trade we're talking about here is just the opposite of that. It's an options transaction where we're opening a put by selling it. We're selling a put to open, a contract position that's open. We're doing that because we expect that this ticker is going to go up, sideways, or slightly down. So you go onto your platform, and instead of buying a put, you're selling a put, meaning you're selling a put to open. That's what the contract looks like, right? By doing that, you take on an obligation. When you buy a put, you have a right to do a variety of things. When you sell a put, you take on an obligation, and that obligation you hold that you're held to that obligation as long as you hold the contract. In essence, what your obligation is you are obligated to buy 100 shares of the underlying at the strike price of the put on or before the expiration date. So, or you buy the put back at whatever price it's selling at prior to expiration. To enter into a put, to actually put one on, you have to have enough cash or margin available to cover the amount required to purchase 100 shares of the underlying. So if you're going to buy, if you're selling a put against a stock that's trading for $100, you need $10,000 in cash or margin there in your account to put that position on for each contract that you put on. I don't know who's here, but Irax is here. Can you guys see my stream okay? Just making sure. So, why do we sell puts? Quite simply, we have a bullish assumption the underlying is going to rise in price or trade in a narrow range sideways, so that we can buy our short put back at a greatly reduced price, or maybe even let it expire worthless. Right? We have a specific price we want to own the underlying at would be another reason for doing this, but we're not going to go through that as part of the strategy today. We'll get into that in the next class, which is going to talk about return on capital and using a short put strategy to own the underlying. So for purposes of this tutorial, just think about the strategy of trading in and out of a short put. So that's why we sell short puts, is because we have an assumption the underlying is going to rise. It's a bullish strategy. Ideally, it rises fast. We pocket the money and we move on and find another one. Okay. So before we do anything else, before we do anything in terms of buying of selling a put to open, we've got to figure out what stock we want to do that on. Underlying stock. What I like here, what I screen for is I screen for high quality companies. I don't want something that's going to go to zero or bankrupt. Some pump and dump $10 stock that's all of a sudden $2. Nothing like that. I'm looking for high quality companies that have a defined trading range that's rational and reasonable, and you can look at. Rational and reasonable within reason, right? That you can look at. So, for instance, by the way, relative high IV is really important, because that means that the puts are overpriced, right? So if you can find a relative high IV ticker that's trading down, that's bottoming, ranging, or is in a confirmed uptrend with a bunch of space above it to go, that's a great candidate. So stocks at support, oversold RSI, and MACD curling higher is one of the things I look at for screening stocks, right? So let me give you an example. Let's take Netflix. Okay. Right now, Netflix is trading on the daily at an RSI of 32, 33. As you can see, going back through the RSI all the way back to June of 2020. This may be the lowest RSI it's traded at since then. Okay. So that's a sign of an oversold stock. You can see that the signal, the red line, which is the 9 EMA, is trading under the signal line. You can see that the entire histogram has been negative since when? Since November 5th. So this thing has been sold off since then, as you can see. So what I'm looking for here is I'm looking for some kind of sign this histogram may be trading back up. And if you take a look at it right here, to here, to here, to here, you can make the case, right? You can make the case that from December 6th until now, that's going up, right? So right now, it looks to me like it's getting more and more buying action and diverging away from the RSI, which has been here. while the stock is still going down. So this is an indication of potential reversal pattern. And since you have some wiggle room when you sell a put, this would not be a bad entry. So that's so as so that's what I'm looking for. Oversold RSI, MACD curling higher, prime candidate, right? So I'm obviously looking for stocks that are not likely to trade lower between opening the trade and the expiration of our put, or at least not fall to our short strike. I make mention here that momentum stocks, you got to be careful because the momentum works both ways. You can get caught in the trap, and so it's really important it's really important you pay attention to that when you're playing momentum stocks. We'll get into that in the second class associated with this. Right now, I'm just going to stick with what I think are fairly decent examples, right? So one of the other things that I like about Netflix, we'll go back to that for a second. We know it's trading at a low RSI. We know the MACD is trending upwards. Now, one other thing that's really important, right, as part of our strategy is it's got a 92 IV rank, okay? So premiums are expensive relative to past history. Premiums are really expensive relative to past history, okay? So RSI is high, RSI is low, IV rank is high, trading near or at support. You could make the case that 568 is support maybe. So it's trading a little bit above it on here. But with an RSI that low and an uptrending MACD, I kind of doubt we're going to get here unless the market flushes. Then it's going to go just because it gets caught up in the storm. All right, so let's just take that as an example. We know it's got a high IV. We know it's got a high RSI. And so let's just take a look at it, a January 21. This is kind of the time frame I like. You can go shorter to play around with it. I like to go a little bit more because I get higher premium for it. But you can see the 520s right here. They're trading between 820 and 875, so maybe you can get this thing for 850. So you open this trade up for 850, right? Probability of profit on that trade is 82%. Probability of 50% profit is 87%. And you are, what, 20 bucks out of the expected move? It's a decent premium. Now, if you're a first timer on this, I don't know why it's not clicking there, but if you're a first timer on this, I might jump to sell this one right here. That's 30 bucks out of the move, or you could even go down here. All right, that's 50 bucks out of the expected move. It's got to drop $50 between now and the third week in January. All right, so you'd sell that right there. You have a 92% pop on that, probability of profit, and that 93% probability of profit here. $360 premium you can pocket by doing that trade. The spread is really good, 360 to 380. Get it right in the middle at 360. And we're selling the 480. So let's go back to the chart real quickly. So 480 would take Netflix to here. Right? 480. Right there. Okay. That would take Netflix to 480 right there, and it's got to get there. Last time it was that far down was in June of this year. You got about 32 or 3 days for it to get there. So that's one of the contracts that I looked at when I was putting this thing together and thought it might be helpful, right? Another one would be Dish. Let's take a look at Dish once. I pulled that up a little bit earlier. Where's that? Dish. Okay, here's Dish trading for $30. Probably, you could probably make the case that it's close to support right here at 28.55. RSI is trading at, this is the daily, right? 33, so it's not quite as cheap as Netflix from a relative standpoint. You could put this on a watch and see if it gets down to here, which would be the lowest. 21.88, which would be the lowest it's traded all year long, and it didn't trade that long ago. At December 1st, it was trading down at that RSI. But one of the things you'll notice here is that this is trending upwards. This is the MACD histogram. From all the way back to November, middle of November, this is trending upwards. So let's see where the IB rank is on Dish, because that would be the third thing that we're looking at. IB ranks 86. Now let's see what the liquidity is. So here's the expected move right here. It's a cheap stock, so you're not going to get a lot of money for playing it, but you can the volume on this right here is 6,650 contracts today alone on the 20s for January. So the spread's kind of weird though. 7 to 14, 522. Yeah, I'm not a big fan of this trade unless you can get $12 each and maybe take 10 contracts. It's a pretty good trade. So those are two examples of how underlines and how I select them. So to review, you want to find stocks that have a relative high IV, are bottoming, ranging, or in a confirmed uptrend. I use the MACD curling to give me a confirmed uptrend. I try to look for that happening with stocks that support an oversold RSI. So that's how you select an underline. That's how we will be selecting underline for this strategy. Okay. Okay, so now you have, and what you ought to do is you ought to have a screen set up. For instance, this is a great one right here, right? FinBiz, I'm sure everybody uses this. You can go in here and screen for RSI. What do I got? I got an RSI. I have 52. I got something trading 60% or more below the 52-week high. You can screw around with that. Maybe 70% below. RSI, you're looking at 30. It's trading at 30 or below. You can change that up to 40 if you want. Gives you more stocks. There's a bunch of different ways you can do that. And some of the stuff here you got to be careful with when you're using, because these things are, some of these are dogs with fleas, so they're going to keep going down. So yeah, they're oversold, but they ain't done being oversold. Probably is the best way to describe it. So that's a good screener for that, the FinBiz. Okay, so we've selected an underline, and I've shown you where to select puts. I'm looking for high volume and open interest in the chain. In the expiration that I'm looking at, right? But you also want to make sure that the overall options chain offers you liquidity further out, at least 3 more months out. So when you're screening through this and you're looking at Netflix, that's the one we brought up as an example, we know what the liquidity is in the area that we're looking at 4 weeks, 5 weeks out, right? You got volume, you got open interest, right? But we may end up having to fix this trade. So by that, and by fixing it, it means we're going to be moving the entire trade out to a month further out, or more than a month further out, and probably a contract further down. So you got to take a look at February and check and see where the open interest is and the volume, right? Outside the expected move. There's some plays here. 730, 765. No volume today. So, where's Apple trading at? IV wise. Okay, so this is it's under the 50 IV. I like them above the 50 for trading, but I know this ticker's got a lot of liquidity. All right. The other things you can do is just, you can sell liquidity in indexes that are really, really liquid, right? So we're going to have liquidity all the way out to sometime whenever, to forever, if you're going to sell using an index. But you want to make sure you've got liquidity not only in the contract chain, not only in the week, not only in the expiration date you're taking, but in several expiration dates further out, so you don't get stuck in the trade. Because there are times you're going to have to fix this trade. That's the beauty of put selling. I can tell you, if you do this right, you are going to win almost every single time, because every trade you get into, if you do it properly, is fixable. Okay? Every single one. So, I mentioned here narrow bid and ask. You clearly want a narrow bid and a narrow ask, right? And I want to try to get as close to the ask as possible, because that's where I'm going to get the pocket the most premium. Also, again, expirations. So you want to take a look at expirations with the highest possible IV. We've talked about implied volatility from the standpoint of the underlying, but we want to take a look at expirations that provide us the highest IV. Close enough in. So I guess if I was, see it right here, 44. So the January, that's because earnings are coming up before that. The January 2022 has the highest IVX, meaning the highest rating, except for this week. This week, the present week on weeklies will always have the highest. Almost always. So that's where I'd be looking to sell because of this. Let's take NVIDIA as another example. So this is a 77 rank. I got to take a look at the chart on this and see where it's trading, but you can see from IVX here, doesn't really matter. Maybe this one, a little bit higher. GME, yeah, right here, 151 on the Januaries. That would be the ones I'd be looking to sell. What kind of liquidity is there here? Okay, so the puts are trading, if you go 110, let's go 20 outside the expected move. You can still get $300. Go 30 outside the expected move. You can still get 260, 270. So you want to make sure now, though, if you do enter that one, that you're looking at February as well, because you may have to roll it out. You want to make sure you got volume and enough volume and open interest outside the expected move. That's important. Like right here, it doesn't exist, so I wouldn't take this trade. There's a shitload of these trades out there, by the way, so you don't need to just jump on something right away because you got to be in a trade, right? So, also, lastly, here on this slide, it says avoid holding puts through an earnings report. Yeah, it's just too much unpredictability around it. You've got too much at risk to do that, right? So avoid risk. The whole purpose of this strategy is to avoid risk at all costs while pocketing the premium. Now, for you guys that have been in my credit spreads, you understand what I'm describing here is something that is enormously more profitable than a credit spread, right? So now let's talk about how to get out of the trade, and you want to know what this is before you hit the submit button for putting yourself into the trade. You want to know what you're going to exit on. And in the next class that I put up here, I'm going to talk about annualized ROI as a metric. I'm going to show you how it works on both sides of the trade. In other words, once you're in the trade, how much money you've accumulated, how much is left on the table when you leave, and how that affects your annualized ROI, because there's a breaking point where it doesn't make any sense to add any more risk to the trade by holding it any longer in time, even though you're going to be giving up some capital by leaving the trade early. And an annualized ROI is really one of the great metrics to help you do that. And I'll be talking about that in the next class because it's an entire class in and of itself. All right. So for now, take 50% off. Take your profits at 50%. You get a $300. You open a $300 contract. Take your per contract. You take $150 and get out of Dodge. All right. The exception to that would be if all of a sudden the stock hits really strong resistance for some reason, whether it's a market-driven thing, catalyst, or whether it's a stock, or whether it's the particular stocks-driven catalyst, or even something related to the sector that's causing that to happen. So news can cause all of a sudden strong resistance to come in. One of the things that's beautiful about a credit trade is your profit is capped. So you're not sitting there going, oh, if I'd have held it only longer, I would have made millions of dollars. No, you wouldn't have. You already know what your maximum is. So whatever you leave on the table, that's the profit you're giving up. But you've also not taken the profit off the table and deployed it elsewhere and put yourself into a trade when, if you do it right, you should get the majority of the move once the stock moves in the direction you're guessing it's going to. Okay? For losers. And I'm going to cover losers in the next class with return on capital, in a very extensive, in-depth discussion about it, because there's a variety of ways that you can fix a trade. Okay, if you're uncomfortable with holding something with a drawdown, then you need to set yourself a percentage of dollar loss trade you're willing to take on it. If you open up a credit for $300 and it goes to $600 and you got to buy it back for $300, so you've taken a $300 loss, it's basically 100%. That's a good rule of thumb, I guess, if you want to use that strategy. But I will tell you, every one of these trades that I'm putting on here and explaining are fixable. And by fixable, I don't just mean breaking even fixable. I mean profiting from them, and profiting substantially. I'll give you just a quick overview. We'll go into more in depth on this in the next class. But if the underlying breaches the put strike, for instance, let's say we've opened up a $100 put on a stock trading at 110, and it breaches the put, it goes below 100. Okay, at that point in time, what you're going to want to do is you're going to want to roll the position, meaning close the current position and open up a new position further out on the chain and with a strike price that's outside the expected move, and that gives you a net amount of net credit on the trade from the get-go. So in other words, you're receiving more credit for opening your new put than the amount you just used to buy back the existing one. To do that, you got to go further expiration and lower strike that's out of the money. I like to stay no more than 3 months time frame on the roll, because I just don't like so much time on a trade like this, because a lot of shit can happen. Okay? And also stay with the strike outside the expected move. And I'm going to go into more advanced strategies on this in terms of being able to size your initial entry in such a way that you can increase the size of your position to help fix it as well. But if you take a put strike, if you take a short put trade before I get to that class, because I'm famous for putting things off, then understand that you should be fairly well enough outside the expected move so you don't have to deal with this issue. Do not do at the money puts. Don't do inside the expected move puts. Stay outside the expected move. We'll get into strategies about how to use at the money puts for making money, a lot more money else, as this strategy unfolds during the course of 2022. Okay. So, quick P&L profile. Your maximum profit obviously is the amount of money you received as a credit when you open it. Right, so you sell a contract for, what do we got here? Let's go back to Netflix. Yes, they are. You gotta type in the right thing, moron face. Netflix, okay, January's. We sell 520s. We sell the 520s. We get $810 in our account per contract. It's a nice trade, actually. 82% probability of profit. So this is the maximum amount of profit we're going to be able to gain by keeping that. Now notice what they're saying here. The maximum loss is $51,190. What? $51,190. Oh my goodness. Oh my goodness. Wow. Well, the reason they're saying that is because on a hypothetical basis, your maximum loss occurs when the stock goes to zero. So if you sell a put for 520 Netflix and you hold that put until, and it doesn't expire, before Netflix goes to zero and you decide to keep holding it, you're going to have to buy 100 shares of Netflix stock for $520 when it's trading at zero. Thus, your maximum loss, which is the 52,000 minus the 810, which you got as a credit, 51,190. Now you see why I suggest in here, or not suggest, insist that you take high quality blue chip stocks that have a history and a trading range, and not some crappy pump and dump that you see somewhere on the internet. Okay, so that's the maximum loss you can get, that you can occur. It is a really rare event. I've never had it happen ever. In fact, my win rate on this particular strategy is enormously high, like in the mid 90s, for a long time. So break even. This is where it's kind of cool, because it gives you, this is where it gives you the wiggle room, is that the break even is the strike price of the put that you've sold minus the premium you received. So let's say, for instance, I have a stock I'm selling a put on for $5 on a stock, right? And it's a $90 put on a $100 stock. It can go to 85. That's my break even at expiration. So even if this thing goes from 100 to 85, right? I'm still even money on the trade. So the stock can move down from 100 to 85, and you're even money on the trade at expiration, because you're sold a 90 put, you got a $5 credit on it, and $90 minus 5 is $85. So that's one of the other beauties, and it gives you a lot of wiggle room. It's giving you $15 of wiggle room on a 100. There's no debit spread you're going to show me. No debit spread you're going to show me, or any long call or long put where you have this kind of probability of success, this kind of wiggle room and easiness to manage the trade. The other long puts, long calls, nothing wrong with them, but you better damn well get the direction right. And I mean right, not just moving by 50 cents or a buck, by where it's moving substantially, so the time value doesn't eat you up, and that you get it, that you time it properly. So you're sitting on Apple for 3 weeks with a contract that expires at the end of the month, you're going to lose money on it. This is a great strategy. That's all I can tell you, and that's why it's used so frequently, right? Is because if you go just one standard deviation out of an out of the money put, right? Take the at the money and go one standard deviation out over and over and over again. You're repeating a trade that has an 85% probability of keeping the entire credit, not just being profitable, but keeping 100% of the credit. That's why it's used so frequently. It's because it has such a substantial mathematical probability of success. So it's successful as long as the stock's price stays above your put price at expiration. And that's why I just referred to earlier in terms of giving you your position substantial wiggle room, because the stock can come down to your to your strike price and even go under it. All right, so you don't need to be exactly correct, just in the ballpark. Now, great, the best trade is one you put on and the stock takes off right away. 2 days later, you close it for 80% profit and take the money and find another trade just like that. If you've done your research correctly, proper strike, expiration, return on capital, good underlying understanding where it's moving to right now based on the technicals that the chart is showing you, this is 4x return on capital than any other debit strategy you'll put up as a comparison, flat out. One of the things that makes it used frequently is a really repairable trade. This thing is fixable to all get out. So let's go to a couple of hypothetical examples. Then I'll give you 2 examples of trades I've done recently, specifically on a ticks, right? And so here's the first one. You can see on the top that's the price. That's the stock price is up here. Options price is down here. Stock you bought, so we enter a 150 short put. That's our strike price. 37 days to expiration. We receive $888 on it. Our break even is 141.12 because the put is at 150. We got this much as a credit. So that's where our break even is, 141.112. We enter the trade. Stock goes against us to start out with, right? See that? It goes against us for the first, boom, 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 boom. The 888 goes to 12, so right here it would have cost us $4, an extra $400 to buy ourselves back on the trade, right? But then you can see what happens to the stock after that. Starts to go up, starts to go up, starts to go up. Value of the put continues to drop. All the way down to here where it expires worthless. And you keep the whole 188. That's why you don't want to jump into you don't want to close the position on these because they're most of the time they're fixable just by holding on to them. Because this thing that you purchased, this thing you sold is declining in value every day. So that's a really quick hypothetical example of a trade going well. Here's one going bad. Here's a stock price. Never really takes off on us. And so our profit profile gets worse and worse and worse and worse all the way up to expiration. And so we opened up a 110 put, 49 days to expiration. We got $420 in credit. 105.80 is our break even because 110 minus the 420 gets you to 150.80. But you can see this thing went bad. Now this is if you hold it without rolling it, and we're going to go into the next class on how you go about rolling it. Okay. Now I'm going to give you two examples of trades that I've done recently. One that just went really well, period, and that is this one right here. So this is Apple. So on November 26th, right here, you can see that. This ticker's trading at support, is what I identified as support, right? And so I decided to take a short put there. Apple's been in a strong uptrend, so I considered this sort of a bull flag that I was looking at, and a pretty good pullback on the indexes that day. So I figured I'd take a short put right there, right? Stock's trading at 156. I short the 145 December put at that time for $145. Here's what it's trading at right now. 2 cents. I closed it already, but that's what it's trading at right now if you want to hold it to expiration, which is this Friday. Very simple example. I identified support. It's right down here, by the way, on the bottom of the EMA clouds, which is another technical support level you can use right at the bottom of that green EMA cloud, short-term technical support. What did I have here? Didn't get a really good MACD reading on that. Signal line going up, this one going down. No, that wasn't a really good MACD signal line, or MACD crossover. But anyway, that's an example of a really easy trade that went well. Now I gave you one that did not go so well, so I had to fix it. And that's NVIDIA. And on December 2nd, you can see the arrows there. It points to December 2nd. Right down here. I kind of decided this thing was trading at support. December 2nd's right there. It had fallen down there once, twice, and now 3 times, right? Once this day, then another time this day, went up again, came back down, and I was looking at a green candle forming on the day, and so I decided to sell a put on it. It's pretty, I don't know where the RSI was, way too high probably. So this is a trade gone. This is not a trade that would have fit the profile I'm just describing to you, but I trade a lot wider examples because I've been doing this a lot longer. But I expect you guys to follow the process and the model that I put in place for now. And you can talk about momentum put trades because they could pay off as well, understanding the risk at some point in the future. But in essence, what we dealt with here was very simple. I opened up a 300 put, I got $550 on it this day. Well, you can see what happened the next day, right? It gapped down to 294. So by the next day already, I've got to roll this baby. So I closed the 550 one for $15. So I paid $1,000 extra to get out of that trade. and I opened up a January 270 for $1,600 at that time. And I did that as opposed to taking a 1K loss. So now I'm looking at $1,600 in credit I've got as a liability. And luckily, NVIDIA recovers here. End up buying this thing back for $630, pocketing about $400 in credit, right? So when you're playing a momentum stock like this, usually short-term trades, and usually 50% is great. Is great if you can make it on there, because you're holding something with too much risk otherwise. So, and we're going to get into that when I get into the return on capital class. So that's where we're at on this trade, on this trading strategy. And I'm going to be following this up quickly as I can with another class that goes into return on capital and how to fix these trades, and some more examples of stuff that has gone well and stuff that hasn't. So that's it for today. I'm signing off. I'm getting ready to see what J-Pow has to say, and if I need to sell my house to cover my losses. So we will see you all soon.